coming up, so that's in our face the most. But the election will come and go, and then we've got to actually deal with after the election anyway. And so what I want to talk about today specifically is to look at some of the external risks. I know when the Minister delivered the budget, Minister Gordon, he alluded to some of that and some of the challenges that he had to actually take when coming on. He I think, termed it getting a hospital pass, which I really do feel sorry for him given the state of a hospital. No, the point is that we are there, but we are also part of the Fragile Five, and that's, I'll talk about these things. And then I want to talk about what happened in 2008, because we had a global financial crisis, and we've obviously struggled since then. But we had an inflection point, so I'll talk about that, and then talk about the elections and beyond. Why, for instance, people think, why do people do service delivery protests, and then they still vote for them? And I'll explain why it is so rational and why you can expect it again, right, until you actually understand the ultimate thing, the national scar that we're trying to actually deal with, we need to actually deal with. And so the first thing is to understand, when it comes to the global economy. Last year, at the beginning of last year, the Federal Reserve in the US effectively really continued with what was called quantitative easing 3. It's actually about quantitative easing 12 by this stage if you count properly. But we call it quantitative easing 3. $85 billion a month being pushed into the financial markets by Fed purchasing assets. Now, when they purchase the assets, they buy bonds out of the market. And what did they buy? Where did they get the money to buy the bonds from the market? And they basically conjured it out of thin air. That's why it's called printing money. But of course, if it's a third world deadbeat, bombed out country like Zimbabwe, you call it printing money. All right. But if you're a sophisticated, advanced, developed country, you call it quantitative easing. It sounds so much nicer, but it's the same thing. But the point is, while you've got the quantitative easing, you've got what we call risk on in the market. People take on risk, and we saw that. The graph I've got there, gold price going down, people selling a asset that they normally take a haven from that. Selling US treasuries, that's the yield going up, which means it's weakening, and that was risk on. Okay, so it was risk on last year, and as they've started to taper, and this is the third taper, if you take quantitative easing 1, they started it, finished. Taper cold turkey. They didn't like that world, because the markets turned down, the economic indicators turned down, and so we then end up with quantitative easing 2. And then they ended quantitative easing 2, cold turkey. And what happened? The markets turned down, the indicators turned down, and they come up with quantitative easing 3. Now they think, well, let's be a little bit clever about this. Instead of just going taper cold turkey, we're going to taper it over a little bit of time. You see, and ease it back. So instead of 85 billion a month, January was 75 billion. February, 65 billion. And they're going to actually ease it off, and hopefully we get into a nice soft landing, but I suspect by the middle of this year they'll get into a world that they don't like, because the markets turn down and the indicators turn down, and then they'll actually stop it. So here we go. We start tapering at the beginning of the year, and it's back to risk off. Okay. And that means that there's a risk to the rand. Right, and we can see that risk on, risk off with the markets. What I've done is inverted the 10-year yield, and you can see as the yield is, the bonds have weakened, the stock market strengthened, and at the beginning of the year, the stock markets came off the moment the taper started. But then an interesting thing happened. The Fed said we're going to be watching the data, and if the data is weak, we might stop this. And the data was weak. Why? Not because the data was weak, because there was a snowstorm. So we know that they're watching the data and the weather, right? And we've had a weak data rebound in the markets. That's strange. In other words, if the market, usually you'd say a strong economy should support a strong stock market. Here we've got a weak economy supporting a strong stock market. Why? Because the market says the quantitative easing will push the share prices up, irrespective of fundamentals. So we've got that. We've got the housing market that's rebounded, but the cold weather, the latest data just didn't look so great because the recovery just turned around. So we will see if it was just cold weather or whether this actually turns around and weakens. Because if it weakens over the next few months, cold weather or not, you will stop the taper. And that's what I think will happen actually ultimately. They'll stop the taper and continue. The lead indicator shot up after they actually started to put in $85 billion a month, starting to turn down now that they're starting to taper. Oh dear. Let's see what happens. I have a feeling they're not going to carry on with this taper. What has happened though is inflation has been coming down. And that's because they've got so much debt in the system that they are struggling to keep this thing, what we call something that's not deflationary. And one of the problems is why I don't think they can taper is have a look at the debt levels. This is US government debt levels. And this is happening across the world. Is that they're going exponential. In other words, the debts are looking more Ponzi-like. And the reason it's Ponzi-like is because the debt, the nature of the debt, is no longer of an investment nature. What happens is that in Western democracy, the biggest weakness that is being uncovered now is that elections are auctions. If the party promises this to get in power, the next one will promise that. Get out of your pockets. Okay, that's what happens is when they do these promises. And so what's happened in Europe, the US, etc., is that they've promised to their electorate way, way more than what their tax base can ever deliver. And so what they're doing is they're borrowing money to pay out the welfare. That's consumption expenditure. And you can't taper Ponzi. And so I think by the middle of the year, they'll have stopped their taper. And so when I look at external risks, this is what South Africa has to actually try and deal with, is we've got the developed world that are digging themselves into a hole. And the only thing that's changed since 2008, the global financial crisis, is they've taken on an incredible amount of more debt to just make the system look like it's actually functioning reasonably well. So I think what we're heading for ultimately, and this is because of the debt, the developed world, is what I call Monster 4. Thank you very much. Where what was Monster 1? Monster 1 was the emerging market crisis. Do you remember the emerging market crisis? Tens of billions of dollars that had to bail out countries like South Korea and Thailand and Indonesia, etc. But we did that. And we bailed them out, and they had very different medicine. They had to hike interest rates and cut back government expenditure, exactly the opposite of what the developed world has done. And funny enough, that seems to be the right medicine, because look how much stronger emerging markets have been since that medicine has been in place. Very unpopular. No politician will ever volunteer to hike interest rates and cut back government expenditure into a crisis, because what happens is that you had despots of 30 years duration that lost their jobs. You know, for a politician, for a dictator to lose your job after 30 years is a big bummer. And you really had that problem, and that's why it's very, very unpopular. But we then went in from there to the dot-coms, the dot-bombs, etc., where hundreds of billions of dollars were lost in shareholder capital. And guess what? Greenspan still did the same thing. As you remember in the emerging market crisis, in the US, he cut rates and the government expanded expenditure to keep the economy going, right? Whereas the emerging markets were forced by the IMF to do the opposite, all right? That's why the IMF and World Bank are still swear words in the emerging market world. But with dot bombs, so what does he do? Cut rates, floods the system with liquidity, and we then get what looks like a recovery, it smelt like a recovery, all the rest of it, but all it was a property bubble that was disguised as a recovery, and we got the subprime problem, where you had the too big to fail institutions failing, whether it was AIG and General Motors and Royal Bank of Scotland, and they failed. Did you see any company fail in South Africa? Not at all. And that is one of the investment strengths that we have, is we've got a corporate sector of note. But it's also one of our weaknesses, and I'll explain why later. But the point is that subprime crisis, we've had tens of trillions. So we've gone from tens of billions to hundreds of billions to tens of trillions. And the next crisis, with the debt levels that are doing, is that hundreds of trillions? If you like, it's the too big to fail institutions that the subprime crisis. The next crisis may well be the failure of the central banks. Okay, in other words, that they don't work anymore. But that's not for this year. May not even be for next year or even the next 10 years. So don't worry about it. What we need to worry, we just need to bear in mind that those are external developments that are occurring. Internally, I thought it was actually spot on with the minister when he delivered the budget 3 weeks ago, when he said, the developed world is saying the emerging markets have to get their house in orders. These are the buggers, the people that actually caused the damn 2008 financial crisis with regulatory failure and all the rest of it. They're telling us to get our house in order. What a nerve. The only trouble is we have to get our house in order. Because what's happened is that we have now joined what's called the Fragile Five Club. Who are the Fragile Five? Well, it's South Africa, okay? It's Turkey, it's Indonesia, it's Brazil, it's India. Why are they the Fragile Five? The reason we're part of the Fragile Five is because we've got a twin deficit problem. In other words, the relationship South Africa has with the outside world is in deficit. It's called a current account deficit. The relationship that the government has with the rest of the country is in deficit. It's called a government budget deficit. And economists are always speaking about the twin deficit, but in South Africa we actually have a third deficit. We actually have a triple deficit problem because households are also in deficit. Households are also struggling because they're actually behind. They're busy digging into their savings. And that's why I like that budget in a macabre sort of way. Because he didn't raise taxes. If he raised taxes, I would have been incensed because that's all the government is saying. We want to resolve our problem by just plonking it onto everybody else who are already sitting with the problem. But he didn't. He said he'd rather claw it back, and that's the strength of the budget. We'd rather claw our way out of the Fragile Five. All right. But when we talk about the Fragile Five, what it means is it means macroeconomic instability. We've been here before. It's nothing to panic about, but it is something to panic about. Because when we say the current account deficit, this is what we mean by the current account deficit. It's what's the ONG? It's huge, okay, and that's why the rand is weakening. Not only that, we've got this budget deficit, and this is a budget deficit. A primary budget deficit. Now, that's a very technical term, so let's just unpack it. If you're a household, you get money in and you spend. There are times you will spend more than what comes in. Like when you buy a house. A house is just an enormous item. So what do when you buy a house? You borrow money to buy the house. I can understand that. I can understand that when you borrow money to buy a car. Because again, the car is a hugely expensive item. It's very difficult to just buy it cash. Very few people can actually do that. All right, but that's capital items, if you like, the big ticket items that you might borrow money to actually buy. But if you buy furniture or clothes or food on debt, you're mad in your head. Sorry, I hope I haven't offended you. Okay. All those with the Edgar's accounts or Lubna's accounts or whatever the case is. But I'm serious. So when I talk about the government's got a primary deficit, what they're doing is they are busy borrowing money to buy groceries. That's the equivalent of what they're doing. In other words, they're borrowing money to pay salaries and that sort of thing. And that's why we're in trouble. So deficit as such is not a problem. If you've still got a primary surplus and you're borrowing money for capital items, like roads and that kind of thing, then people don't worry about it. But when you've got a primary deficit, they worry about it. And then, of course, the households also don't have these deficits. And that's the challenge that we have in these type of worlds. The budget deficit, for instance, as a percentage of the economy, is already back at the levels that we got. Remember in 1994 when the old nationalist government handed over a country that was near bankruptcy, or it was sort of declared near bankruptcy, we were to the new government to say, well, thanks, good luck, and all the rest of it, etc. We're back at those levels, at least at the budget deficit level. When we talk about the debt levels, it's the same thing, so I'll do that in a moment. But what that means is we've seen it in the currency. Because this currency, and I've got the fragile 5 here, and when it goes up on the chart, it means that the dollar is appreciating against the rand, Indonesian rupee, and that's why it is so. Up means weaker. In other words, the currency last year, the rand was weakening during a risk-on period. And technically that means we should have been strengthening last year as the dollar was weakening. But the dollar was weakening against the euro. That's the green line there. I know it's not that clear. All right, it was weakening against the majors, but not against the fragile 5 currencies. And that's because of the deficits that we are in. All right, and that's what it's about. Fragile 5 is not like Greece. Greece was a situation where the government went bankrupt. And our government is nowhere near bankrupt. I know they're trying hard to change that, but we really are nowhere near bankrupt. And that's because we have been managing our affairs reasonably well until a point, and I'll explain that point at the moment. So when we look at something like Greece, when the government goes bankrupt, there's their stock market, 91% down from its thing. If you were in shares, if you were an investor in shares in Greece, you were taken out on a stretcher. And likewise with the bonds, the bond yields go from 6%, goes right up to almost 40%, and then you have this little haircut. I can tell you if you were a bond holder, you were also taken out on a stretcher. And that's what happens when your government goes bankrupt. There isn't a single asset within that country that will hold up. Right. Now that's not South Africa. This is macroeconomic instability. We've seen this before. For instance, in 2008, right, the rand weakens 1998. Remember that was the rand crisis where the rand really fell out of bed. It went from 5 to the dollar to 6 rand 40. And we had to hike interest rates to 25.5%. If anybody remembers that, you can remember. Very painful time. But the rand weakens 20% in that time, and resources shares on the stock market are up 80%. I can tell you if the government was bankrupt, they would have also been down. Okay? But this is what I'm trying to say is that the macroeconomic instability is disruptive, but it does provide some opportunities in the market, because it's not, all it is something that needs to be repaired. So when we talk about fragile 5, it's just, whoa, hell's teeth, there's people being negative again. There are opportunities. In another sector like financials, same period, you find financials went down because they don't have a rand hedge nature, because you usually see this macroeconomic instability mainly in the currency. And we're seeing this. The Indians and all that are struggling as such. So when we talk about the challenges of the country, that's what we are talking about. But what we did see is that we saw quite a big inflection point in 2008. And I know the politicians amongst us will get very cross with me, but let's see how we go. 2008, we have a global financial crisis. The point about the global financial crisis is that it was global. Okay? In other words, it hit South Africa and every other country in the world. So when we take a look at something like this, this is unemployment. You can see through 2000, from 2000 right up until 2008, unemployment coming down. And what I've got there is South African unemployment rate and Brazilian unemployment rate. They're a very similar country to us in many ways. They're also resource, depending on resources and that kind of thing. And so the global financial crisis hits. So what happens to unemployment afterwards? South Africa's goes up. Brazil's keeps going down. Which one's the odd one out? In other words, which one was the exception in this world? Okay? And I then ask the question, Who's the aberration? Which is the odd one out? And unfortunately, you start going through the data. Let's go through some data. This is unemployment rate. This is from the IMF, so it's a different source. Brazil's, all the ones I've highlighted in blue are unemployment rates that went down. And then you had some unemployment rates that went up, and you can see I pity Spain, the pain in Spain. Anyway, but they've actually overtaken us on unemployment rate, at least on that. But basically, can you see other emerging markets, which are also hit by the global financial crisis, their unemployment rates come down. The developed world had their own little thing. It was really only Germany that came out reasonably well out of that particular story. But South Africa stands out. So something else happened in 2008 other than the global financial crisis, and that was Polokwane. Okay, that was Polokwane, because what happens, we get a little shift to the left, and the next year another little shift to the left, and now we can step back and actually assess that the route we've gone on in the last 5 years hasn't been that great. So I know this is where I start saying, when do I run for the door and all these things? Let's see how we go. So I can understand when we say, for instance, is this country a better place since 1994? Let me tell you, it is vastly better, but vastly better than 1994. Is it a better place since 2008? It might be, but I struggle with the answer there. Okay, let's keep going before I get into real trouble. Right. You can see what I'm talking about in inflection point. Into 2008, you had interest rates that were structurally moving downward. You had the cycles. You had economic growth that was structurally moving upwards. Since 2008, we've had interest rates coming down, and the growth rate's also been coming down. Okay? In other words, the relationship has changed. You know, when I talk about an inflection point, you can now see this 5 years down the line. Okay. I have a funny feeling if the deputy minister was here, he would have already been climbing into me. So, anyway, but I'm just saying, there it is. In terms of growth, this is just economic growth, just to show you on the vast regions, the global economy in 2008, 2.7% growth. You've got the recession in 2009, that's the leads and lags. By 2013, that's last year, we're back up to 2.9%. Your advanced economies were already hit in 2008 because that was where the epicenter of the problem was. So they're slightly faster, but you can say 1.2% is deathly slow. It's not that great. The emerging markets holding out quite well. Developing Asia is holding out well. South Africa stands out a little bit, even in the sub-Saharan region in which it isn't. South Africa is included in that sub-Saharan Africa. And because of the weight of South Africa, it actually holds quite well. If you take South Africa out, you'll find that sub-Saharan Africa is quite a bit faster than that. So it does say that we are underperforming in one sense. We're outperforming in other senses, but we are underperforming. I'll explain why, because it's not necessarily something I can even necessarily blame politicians for, but I could certainly blame them for listening to economists in one sense that don't get it. And not that I necessarily got it. I promise you I'm not that arrogant, but I can say we've got a problem. Debt to GDP, same thing, right? The IMF didn't have global averages, but you can see advanced countries, what they've done is they've used the debt to pretend they've got a recovery. Okay, that's what they've done. The emerging markets, look at that debt level, flat. The emerging market growth has not been driven by debt. Certainly not government debt. And that's why it's such a more powerful thing. Sub-Saharan Africa, a little bit, but you can see the debt level in South Africa also kicking up. So a lot of the growth that we've seen is because of debt. So the 1.9% growth that we got last year, a lot of it is just debt. If you just take the debt away, what would it have looked like? And we may have looked at recession. So, you know, just looking at this thing, On the GDP per capita, again, you can see we are better than emerging markets on average. We're better than Asia, etc. But we're not making the rapid progress that they are making. For instance, where you've got an almost 20% gain in emerging market in per capita income, the advanced economies sort of we're matching that more than anything else in terms of GDP per capita. But you can also see the debt levels, the inflection point, the debt levels rising, and then in 2008, that inflection point where it rises higher. And Robin Gordon was actually saying that in the budget, that we've borrowed a huge amount of money to keep things going and that type of thing. And it's because of the Keynesian type of economic approach that they are basically taking. So basically, we try to spend our way out of trouble, but spend our way into the fragile five. That's what's actually happened. Right. So, but all is not lost. We have had a second inflection point, and that was Mangaung, okay, where the National Development Plan has been adopted as policy. And I'm hugely encouraged by that. Hugely. Because it's a policy that I think most people can live with, except the loony left. That's the only ones that can't live with it, but bless them. All right. So what does this mean from the election point of view, and what do we actually face? All right, the first thing that we face is that we're reaching what I call the point of maximum pessimism. All right, the rand has been weak. A weak rand is like getting a salary cut. I hope you all enjoyed your salary cut. Okay, it's pushed the petrol price up. I hope you're all enjoying filling up your car these days. Really. And I hope you're enjoying your interest rate hike. That's also to do. All of these things have helped to take money out of our pockets. And the weak economic growth means that the economy is not really strong enough to put it back into our pockets. So we're going to get to the point of this election where I think that politicians may be tempted, and this is where I was hugely encouraged by the budget. It was not an electioneering budget. This was a stabilization budget that will see us well through the election. All right, but it wasn't a growth one, and I'll explain why now and what the challenges are. Okay, but the point is that when you have an election and a weak economy, you as taxpayers want to run a mile, because the politicians will say, if you're promising that, we'll promise you even more to get elected, and they're promising more out of your pockets. Okay, fortunately, we've got, and this is the advantage of having an incumbent government that is not threatened necessarily by the elections, is that they have to live with their decisions before the election. Whereas in Europe, for instance, if you've made that decisions beforehand, it may be somebody else that has to actually deal with it. And then you can blame them for your bad decisions. Right? Because that's what often happens. All right. Bush could blame Clinton. Clinton could blame, well, Bush, and so on. And Obama could blame Bush, etc. And so it goes on. But in fact, the leads and lags suggest often the problems that the next president get were actually already laid previously. In South Africa, we don't have that. We've got a government that can and does plan through the election terms and for the long term, and that is a huge advantage. I'm not sure if we always get that advantage, but it is a huge advantage that we do actually generate. We can start with the rand. Why the hell not? And this is just the relationship that occurs. And if you start and you get a weak currency, what happens? The weak currency filters through into higher producer inflation. And as the factories experience higher inflation, they pass that through into higher consumer inflation. That puts Jill Marcus into a bad mood, and she hikes interest rates, which of course takes money out of our pockets, so demand in the economy starts to drop, which of course then negatively impacts economic growth. So economic growth slows down as that happens. But what then happens, because demand has dropped, we import less, so the trade balance starts to improve, and that takes pressure off the balance of payments, which of course, once that starts to happen, leads to a currency that starts to regain its footing and starts to strengthen, which then filters through into lower producer inflation, which then of course filters through into lower consumer inflation. Jill Marcus gets a smile on her face, and she then cuts rates, and we then go shopping. Economic growth picks up, but the trade balance starts to deteriorate again putting pressure on the balance of payments and that kind of thing. That cycle tends to last about 2 to 2.5 years. And you can see where we are. We're in the higher inflation. Interest rates have started to rise. I can tell you by the middle of this year, you'll have already seen the trade deficit start to actually close, etc. And by the end of this year, we are in an upward cycle as far as the economy is concerned. So we're reaching the point of maximum pessimism at the moment. And so it's good to actually put that in perspective. But there are a couple of things that we are actually battling with as a country. And this is where I think from a business point of view, what do we actually still start to be looking at? And I get a sense of frustration, and I'll explain why I think that frustration is going to get more and more, is that we're part of the Fragile Five Club. We have to get out of it. I think within 2 years, if the budget trajectory is correct, we'll have actually clawed our way out of the Fragile Five. We will have clawed our way away from the edge of more credit rating downgrades, for instance, and that I think will at least give at least some sense of confidence in that. That's one of the things is that you'll find in, when the hike rates earlier in January, think, phew, a weak economy, ahead of elections, emerging market, what the hell does that tell people? And what it tells you is that we've got strong institutions that are able to take decisions outside the political influence, right? And that helps set the platform for enormous long-term confidence. Because the last thing you want to do is have a central bank that's being conducted through parliament. So the last thing you want. You need an independent central bank. You need institutions like the public protector, all of that sort of thing. And that's the strength. Why South Africa went through transition in 1994, that is something that's unparalleled in the world at that particular time. All right, that we can actually go through because it was managed properly. It wasn't, like some invading force that took over and say, well, we King Kong and we'll run things as we are. This was a well-negotiated process. You've got institutions like the Independent Electoral Commission. I can remember being asked once by a media person, my assessment of political risk in this country, because the rating agencies said whatever political risk, and this was when the whole issue of nationalisation was being debated, and that's where they were actually going. And I'm saying, I asked them, and we just had the municipal election, I said, political risk, what on earth do you mean? Because we've just had an election. If you're looking in the financial markets for any sign that we had an election, you will not see it. The volatility in our financial markets as a result of people saying whatever they like in politics, you can't see it. And yet later that year, the Greek Prime Minister said, maybe we should have a referendum, this is just in Greece, over the bailout packages, and there's pandemonium around global markets. And you've just got to say, right, we are confident in our institutions. Okay? So that's one thing that we do. So when we talk about political risk, I'm saying, what do you mean by political risk? And they're talking about nationalisation, etc. So firstly, you've got to get it past the Constitution to actually get nationalisation right. And the second thing is, we've just had an election run by an ISC that's worthy of a AAA rated country. And that's why it's important that we guard the institutions and make sure that they aren't compromised, etc. But that's an important thing. We're out of the Fragile Five Club within 2 years. But we've got slow economic growth and fast welfare growth. That is simply unsustainable. Okay? And one of the reasons is we've got an enormous amount of unemployment, and our capital formation, in other words, our savings, is too low. And I'll explain that now. And one of the problems is that we've got this, the government tells me constantly, we've got this trifecta of problems, or triple problem of poverty, inequality, unemployment. And they usually say it in that sort of order and that type of thing. All right. And what does that tell me? Who is going to take their own personal money to try and invest in poverty, inequality, and unemployment? Because investors look for opportunity, they don't look for need. And we've actually positioned this economy as need. So we need to shift that. It's just really sometimes a marketing ploy. Do you remember Africa? When African leaders were to go overseas, they took pictures of emaciated babies with flies all over it and say, please give us a whole lot of money because we're battling. You don't see that anymore. You've got a much more self-confident Africa to say, actually, we're a country of opportunity. Come and have a look at our opportunities. We don't have emaciated babies to put in your face. There might be that, it's not that they've disappeared altogether, but we don't have that approach anymore. All right, and I think we should adopt something similar, as that we are a country of need, of opportunity as well. Very strong opportunity, and when you meet opportunity, you can often meet need. Not necessarily so, but you can actually meet it. And one of the problems is that we don't actually prioritize policy. We talk about poverty, inequality, and unemployment as if they're all the same. But in actual fact, it's an unemployment problem, primarily, from which there is a poverty and inequality consequence. But we've been trying to deal with the inequality and poverty, right, through a particular route which is starting to do damage. And I'll explain why. It's not to say that they shouldn't be dealt with, right, but it's important that we now start to shift the pendulum. And I'll explain why. For instance, if we understand it's an unemployment problem from which there's a poverty and inequality consequence, we then should prioritize policy that way. If we try and deal with all the problems at once, you'll find as what we've done, right, whereas the intention, and let me tell you, there is no shortage of very good, well-meaning, well-based, well-founded intention within government, all right? And people's got to be very careful, you know, when they say, they used to product, whatever. There are an enormous number of people who really want to do the best for the country. And you need to understand it, engage with it, and as I say, do that. But when you're trying to solve all the problems at once, what happens is that you've subjugated unemployment in deed, in other words, in what you are doing, not what you're saying, but what you're doing, to the lowest priority that we actually face. And you can see this, for instance, when we set up, say, the Consumer Protection Bill. Very nice, you're very well protected consumers, and I think the intention was great. People who actually designed that should go to heaven for their intention and all the rest of it. But it made doing business more difficult, especially for small business. All right? And what it did, it then pushed unemployment to a lower priority than consumer protection. Is that what we wanted? And I'm not sure if we wanted it. We said, go back to the drawing board and redesign that. Not just say we don't want protected consumers. Redesign that so that unemployment is actually shows as the priority in terms of the things. And if you can't do that, then maybe we shouldn't have that bill. Right? Because we need to actually resolve unemployment as our first and foremost thing. And unemployment requires investment. Okay? No economic activity comes into existence without investment. All right? And so you need investment. What funds investment? It's savings. And this is where I actually battle even with my own colleagues. And so I've got to ask them the question, what investment gets funded without savings? And there's none. They'll tell me, oh, you can use debt. Oh, well, that's future savings, but it is still savings. Okay. Oh, you can use foreign investors. Well, that's foreign savings. Okay. It's all backed by savings, ultimately. And so this is where we've got a problem. Whereas inequality and poverty is about redistribution. Okay? That's the basic thrust, and the government has actually done enormous strides in trying to deal with inequality and poverty through the process of redistribution. And I think that's reached an exhausted limit. I'm not saying it shouldn't happen, I'm just saying it's reaching an exhausted limit. Because at the moment what we've got is very unsatisfactory outcomes. Because people don't want to say, well, that's great, the grant is great, but that means I stay unemployed. Would I rather forego a grant for employment? I think I would. Most people would. Okay. So this is the problem. We face what I call is a fundamental macroeconomic mismatch. Is that we've got an investment rate of 19% of GDP. Now, if we keep a 19% rate of investment in the economy to GDP, we will achieve a 2 to 3% growth rate. A 19% investment rate is commensurate with about a 2 to 3% growth rate. Okay. The trouble is, we've only got a savings rate of 13, 14, 15% in that type sort of order. And because of that, we've got this mismatch. It's one of the reasons why we've got this current account deficit, is that we're trying to invest at a rate faster than what we're actually creating capital. So we need to get that investment rate up. And unfortunately, to get a growth rate of 6, 7, 8%, that sort of area, you need to be investing at a rate of about 30% of GDP. So we actually have to increase our investment rate by about 60%, and we have to double our savings rate. That's what we actually have to do. All right, because the reason we need the savings is to rebalance our economy. Our economy, as I've said at the beginning, we've got fabulous big businesses. They're able to compete internationally, etc. One of the reasons why the economy is structured like it is that during the years of apartheid, what happened is that the corporate sector was trapped. We were isolated. They outgrew this economy. Right? They became too big. The economy became exceptionally concentrated. It was eating itself. You had companies like South African breweries that owned Edgar's, for instance, and that type of thing. You know, odd things, because where else do you put your money? So you just buy what's available, etc., and you've got these odd relationships, and you've had, to a certain extent, this at least alleviating as corporates have looked elsewhere to spread their wings and that kind of thing, which is a natural thing to actually happen. But we've got this missing middle. Because the corporate sector outgrew the economy, we don't have that mass of small, medium enterprises, because that's your job creating engine. It's the companies that have proven their business model. They're employing 40 people, and they actually, in 5 years' time, they'll be employing 80 or 100 people, or even more, because that's the phase of their growth. I can tell you, pick a name, Absa, Standard Bank, South African breweries, whatever, pick a name. None of them are going to actually be expanding their employment base by that amount. If anything, they'll be doing more with less, because they've got to compete internationally, so they've got to constantly be pushing the productivity barriers and that kind of thing. So your job creating engine is this, and this is why South Africa has this unusually high unemployment, is because you don't have this mass of businesses. The other problem is that the desperate businesses, the subsistence businesses, the traders, the robot entrepreneurs are being hounded out of the economy. It's not like you're trying to actually say, let's try and support and stabilize the sector so that somebody who's got 100 rands worth of capital builds that up into 5,000 rand of capital, and 5,000 rand of capital gets built up to 20,000, and they change from a micro enterprise to a small enterprise to, you get that progression. They hate it. They are a nuisance. They make the place look untidy. They're all these foreigners anyway, and that kind of thing. And we've got to be very careful, all right, because that is part of our solution to job creation. Okay, we've got to actually try and support it. But this is the problem where we've got with policy, is that small businesses are shut out of this economy. Because when I talk about the trifecta of mistakes, we've got the trifecta of problems, poverty, inequality, and unemployment. The trifecta of mistakes are labour unrest. You cannot strike your way to investment attractiveness. That's never worked. Okay? No investor in the world wants to invest into labour unrest. We've got to find a way to protect our workers and all the rest of it. And I don't have a problem with that, because I'm actually quite supportive of unions, believe it or not, because I think they do have a very valuable role to play in big business. But we need to actually set it up in a way that you don't end up with strikes and labour unrest. etc. And one of the things is the tripartite alliance may well be doing the damage, because you've got political ambitions of the union leadership, which are not the same as the actual shop floor issues of workers. But of course, if you've got this massive army behind you, you can say, you've got to listen to me and give me a nice cabinet post and all the rest of it, because I've got 400,000 members or whatever. So I'm only more flippant. But that's, I think what's happened is that you've had that divergence. And so that's one of the problems. But the other problem is regulation. Okay? It's not just any single regulation. I can tell you, if you dropped labour legislation, and listen to me, I'm a free market economist, if you dropped labour legislation in its entirety, you would create very few jobs. So how does that work? It goes against all theory. The reason it won't work is because of this. We don't have the entities that can actually generate those jobs and actually absorb it. We need that missing middle. So how do we get that missing middle? And the regulations, how they are done, it's not the single regulation. If it was only labour regulations, would be soaring as a country. It's the regulatory onion, the layers and layers and layers. And the biggest problem is not for big business. If you set up something else, poppy is coming up. It's going to cost us a hell of a lot of money as a company. We set up a little department to actually deal with it. The rest of us carry on with our work. The trouble is, these regulations require economies of scale to be compliant with. And that's what small businesses do not have. So I would make this assertion. No small business in this country operates fully within the law and still is solvent. It's too costly to be fully compliant with all of this. And it's marvelous stuff, but it was never ever set up with small business in mind. And so when I listen to the budget and they say small business, I think the thinking is glacially changing there. But everything in the budget was, we're putting this in for discussion. There were no concrete measures for small business in this budget that was of any meaningfulness at all, that will change your lives at all. Okay? So that's why I don't think it was a growth budget. So let's just see. This is the problem that we face. We need to actually start shifting away from poverty alleviation and start looking at poverty reduction. You know, there's a huge difference between the two. And poverty alleviation is shifting resources to consumption. Because it's about grants, it's about the free water, houses, all of that sort of thing. We give you all the trappings of income, but not income itself. Whereas poverty reduction is about shifting resources to investment. It's not one or the other. Right? Because how do you get the investment thing is a longer timeline than the alleviation. And alleviation has to happen now. Because not something in 4 or 5 years' time or whatever the case is. But we need to shift that thing because we've basically only done poverty alleviation, and that's how I judge the budget. Where's the tilt? Was it to consumption, in other words, more alleviation, or was it to investment? And there was a glimmer of that, but ever so little. Certainly might take investment rates from 19% of GDP to 19.05% of GDP, but it was the first shift that I've seen ever since 20 years. So it's the first time I've seen it. So although I don't consider that actually a step to resolve our problems, at least the thinking is starting to tilt that way, and that's encouraging. The other is, that deals with poverty. How do you deal with inequality? If people earn a lot, what do? You make them earn less. Okay. In other words, you tax them so that they earn less. That's how the tax system is designed. All right? So if you're earning something, the tax takes it away from you. Right? And they pass it on to the people who are not earning in the form of grants. And that then closes the inequality gap. I know we're supposed to be one of the more unequal societies on earth. That's before they've done it. After they've done that, the actual inequality closes quite a bit. just by the way. Right? But it's the case of, that's the policies of take. Whereas we've actually now got to see, can we shift to the policy of make, where the bottom, where the wealth gap is closing because the bottom is actually starting to earn more because you're getting jobs. That's the first step in the process. But you've got to actually say, and again, it's not either or, but it is a case of how can we get the bottom earners to actually earn. All right, and that again requires investment. To investment, and this is where I despair when it comes to the taxes. When we've got a huge unemployment rate and we've got a deficiency of saving, the taxes on saving and investment viability are the most damage we can do to ourselves. Okay, and these are taxes on dividends, taxes on interest earned. You know, savers earn interest. If you earn interest, you get more tax. If you actually borrow money, you can get your tax reduced. Does policy favour the borrower or the saver? Okay, and we need the saving. All right, so we need the saving and capital gains tax, tax on transfer of property. All of these taxes are enormously damaging because to fund small business, the savings needs to be in the household. That's where it mustn't sit in the corporates, it must sit in the households. That's funds small businesses, that actually generates the growth. And so we need to actually generate savings, not anywhere but in the household. We then need that saving to translate into investment, and that then investment then translates into growth. And that's basically where we then expand the tax base and lower the welfare burden. And you start to get into a virtuous circle, and the National Development Plan, I think, speaks very eloquently of that, of that burden. So effectively, what I'm saying is that, when it comes to, after the election, this is what I hope the thinking will shift to. We've already got the revenue sorted out. What happens is that if you earn, the taxes are what's called progressive. In other words, you earn more, you pay more, and you get paid up to more than 40%, and then there's still VAT and all that you still pay. So that helps to reduce inequality, but reducing people's income is not good enough. We've got to start bringing income up. We've then also got to take the aggressive redistributive nature of expenditure helps with the poverty alleviation. No problem with that. That's dealing with need, right? But that's reached its limit because you've got an exhausted tax base already. Very narrow. To then say, open the window at investment to say, from a tax point of view, if we save and invest, we can avoid tax, and if we consume, we incur tax, so that the behavior of people can change to say, instead of buying a flat screen TV, let me rather invest in my business and create jobs. Okay, you can have one flat screen, but not dozens. All right, we need to actually start doing that. So the tax system can help open the investment so that this becomes a country of opportunity rather than a country purely of need. One of the things that you see is that there's a big shift between the developed world and emerging markets, is that the share of the developed world, the contribution of the developed world to the global economy is diminishing as it is rising in emerging markets. And so you can see that big shift. But I can tell you, if we do not get our house in order, that's the same shift that you can draw the same graph of South Africa in Africa. And we will disappear in terms of our prominence, importance, etc., if we don't actually get our growth, unemployment, and that sort of thing down. And that's why it's important to get the investment side sorted out. There's other things that we will have to deal with, and this is going to be, from a post-election point of view, an extremely difficult thing, is how can we be ethical when it comes to our foreign policy? Because just from an oil point of view, this is the Middle East. 5 years ago, it was largely stable except for two countries that had civil war, and the Americans were trying very hard to stabilize things, I think, or something like that, in those two countries of Iraq and Afghanistan. But 5 years down the line, the region really has destabilized. And while Syria is Syria, it's curious, it's a curiosity for us, it's not very nice, etc., but it's curiosity because it's contained within Syria. But I can tell you now, if that Straits of Hormuz is blocked and we can't get oil, all right, and they're using oil as a leverage and that sort of thing, and you've got $200 a barrel, we've actually got to be mindful that we could be cut off. And petrol can become extremely expensive in that setup. So what do we do? Okay, one thing is to frack. And I know the anti-frackers will hate that, but it helps to generate energy self-sufficient. But it also says, how does our policy go? Do you actually say, foreign policy then shifts, the Israel-Arab debate, for instance? Do you say we'll support the despots because they're supplying oil? That kind of thing. It's difficult. What about this? Who'd have heard of Ukraine before last week? Or no, it's more significant thing. But you hear Ukraine today, Tajikistan tomorrow. All right, do you know where Tajikistan is? Okay, it's also an ex-Soviet republic, closer to China, on the sort of Chinese border side. But the point is, you've got significant number of Russians in there, but do you remember another little country in 1938 was also accused of having a whole lot of Germans in, so that means therefore we should take over swaths of your country, called Czechoslovakia and the Nazis, etc. The last thing we need that, but remember, Russia is our partner in BRICS. Where do we tilt? On the right or the wrong? And there's another little instance where BRICS are involved, called China and Japan. Well, China and Japan are no longer China's, or something like that. They could also have a big fat fight, which will make life more difficult. Okay, and so that is another difficulty. Where do you go for foreign policy then? Okay, because the Japanese are very significant players in our economy, and I'm sure most of you would prefer to drive a Toyota than a China. Anyway, but just Tata's India. Or a Cherry. Yeah, it's just one of those things. So we need to appreciate these are going to be challenges that we face. Fortunately, we're in quite a good part of the neighborhood, good neighborhood on the world. We're unchallenged and that kind of thing. So it makes it easier. We don't need to actually buy expensive armies and actually we do or don't. Anyway, that's still going to be sorted out. So what of the election itself? I can finish with this and say, what do I think is going to happen with the election? Try and understand the value chain. Okay, one of the things is, it's one of the things we've been evaluating as we've visited the various BRICS countries, is this thing called a national scar. Is that something happens in a country that's so bad that it almost mangles everything subsequently. So you take a country like Brazil, which sounds very, very similar to South Africa in many ways. So it's got the racial spectrum, it's got the wealth divide, it's got the skills problem, all of these things. An authoritarian past, it had a military government right up until 1985. They also had a peaceful transition, by the way, which was, again, a surprise. But not necessarily, but Brazil was able to do that. But the thing that bothers them the most, what really strikes fear into them, if something ever had to return, it's like apartheid returning to South Africa. It's like ghastly to contemplate and that type of thing. But is the return of inflation. And you can ask them, and they repeat that over and over again. And so that's where we thought this is a national scar, because they've been through a hyperinflation. Their hyperinflation lasted from 1980 right through to 1994. It peaked at 30,000% inflation. Now, when you get your salary and inflation's like that, you don't say, well, let me quickly finish this. You get your salary, you leave everything, and you dart and you convert it to baked beans or whatever. You'll swap with your neighbors later. Your time horizons are so short and that type of thing, and your standard of living is plunging as a consequence of prices going up and your salary is not keeping up with it. It's devastating. You can see this with Germany, the same thing. Right, they had a hyperinflation in 1922-23, and they're still anti-inflation, whereas the Americans are anti-deflation because they suffered a deflation in the 30s. And these are scars that countries carry, and you then mangle it. So Ben Bernanke and the Fed would rather print money and risk hyperinflation than to actually go through another depression. That's basically what it means. They'll mangle policy, and we've got to be careful of doing the same, because our national scar is in fact apartheid, and it's a peculiarity. It's very important to South Africa. It's important to nobody else in the world. And when people come to invest in South Africa, and they've got to try and muddle through this tangle of stuff, right, it's much easier to go to Thailand. Sure. The struggle and the custodianship of the struggle is the most valuable election asset. Bread and butter issues come way down there, and this is why people think, from a middle class city, you're sitting in your life, how the hell can they're protesting against this, that, but they're going to vote for them anyway? Well, the reason is that the struggle custodianship is much more important than bread and butter issues. So people would say, I'm happy to vote for the ANC, and I'll protest in the streets for my service delivery. Okay? And that will continue, and the ANC can rely on that. And that's why this election, they get 62%.
Sure.
Quite easy.
Sure.
That's my prediction. 62% is my prediction. 62, 63, somewhere around there.
Good enough.
All right. Somewhere around there. All right. The risk to the ANC is that the gap between service delivery and bread and butter issues and the struggle is widest in the older generation. The ones that can remember the hooter going off at night. Okay, the ones that can remember having to carry the bill pass or being chucked into the back of a van because they didn't have it with them, because they just slipped out of doors for a second. All of that rubbish. They will, but the younger generation, not necessarily people born freeze, but the people even born in the late 80s, 89, 90, don't have any memory of apartheid as such. The bread and butter issues are narrow, and the struggle are narrower with them, okay, than the struggle issues. So the ANC's risk is not this election. It'll be 2019 when the so-called born frees are in the majority, urban, and they say we can't eat struggle, we want jobs. Okay? So I can tell you, the ANC will win now, very comfortably. Okay? If they get the economy right between now and 2019, they will be unassailable. If the economy works between now and 2019, they will not be able to be touched, because the only thing an opposition party can actually come in with is bread and butter issues, which is way down the list at the moment. Okay, so understand, if one understands that, and if only the ruling party understood that they need to get the economy right. And getting the economy right has got to be very careful, and this is where I'll maybe I should end almost like that, is we have to actually incorporate everybody as part of the solution. Thank you.
Thank you so much, Chris. That was really, really amazing. I think enlightening for a lot of people. And I'm sure there are a lot of questions. But looking at the clock, we have like 5 minutes or so. I'm hoping to get something from the Born Free. He's right there at the back. But, okay, we're going to walk around with the mic. Any questions? Okay, Peter.
Here's another one.
You need this one, okay. Not a problem. Okay, the mic is here. Let's start here, table 6.
Hi, Mr. Chris Hart. I see everyone is talking much about the current account and they're not sort of like raising issues about the capital account. Should we worry about the capital account or we shouldn't worry about the capital account and worry more about the current account?
And then there's another one from Peter this time.
Can we divide savings into voluntary and involuntary savings? In other words, why doesn't the government borrow from us?
Okay. Do you want to start answering those questions while we
Yeah,
give the microphone
because
to
the current account and capital account, basically, when we talk about the balance of payments, that's once the current account has been sorted out and the capital account, it should come into balance. So basically, if you've got big payments like interest and trade deficits, etc., that's your current account. If that's in deficit, you have to have inflows of capital to balance that out. It's not always easy to measure. The Reserve Bank really does try hard to actually pick up all data and that type of thing, but some of it has to be anecdotal and that sort of thing, and that put in balancing factors. But you know, when the currency is weakening, right, it's the best indication to say you're actually getting capital outflows. In other words, investors are leaving when the currency weakens, and then investors are arriving when it's strengthening. And that's why there's always the battle where people say, well, we should have a weak currency to help our exporters, and that will help to create jobs. What you're actually saying, how do you get your currency weak? We say, well, we need our investors to leave so that we can grow our economy. And that's why a weak currency never really works. Okay. But yeah, am I worried about the capital account? The answer is yes, because the capital account tends to be in shorter dated instruments. You know, when I say there's no volatility on short-term flows as far as elections and that sort of thing are concerned, where we are seeing damage because of policy uncertainty, right, is in your longer-term flows, right, and that's the hassle, because what happens, think of it in investment timeline. If you're going to invest in a power station, it's a 30, 40-year project, right? You need low interest rates for that. You can't finance that with interest rates of 40%, for instance. So that's why the macroeconomic stability is important, because it helps to keep your inflation down and that sort of thing. And it helps to enable long-term projects. But a mine, you sink a mine shaft, it takes 12 years before you even start getting the first income, and you've got geological uncertainty, huge thing. That's a long investment timeline. Now we, in this country, people were prepared to do that. The only trouble is that the investment timeline has been shrinking because of policy uncertainty, that we're no longer prepared to do that. And so you've seen this in decline. We've got to be careful of what I call, can I call it shebeen chatter, you know, or dinner table chatter, where you sit around the table and you just throw out something and it sounds right because it's been repeated and that. And one of them is to say there's been an investment strike by the private sector, and therefore, and you say, what is the story? Companies are sitting on piles of cash and not investing. You've heard that. Is that true? Well, if you take me on, you're now going to take your head off. But the point is, no company sits on piles of cash. They'll always use it. You can always argue whether there's too much cash or too little. That's another discussion. But nobody just sits on cash. That's the first thing. The second thing is 2/3 of all investment, of that 19% that I was talking about of GDP, 2/3 of that is private sector investment. They are investing. Okay. Could they invest more? The answer is yes. Okay. But the capital account is in deficit. It's not in deficit. We are getting capital flows in. It's just that we should be able to plug that gap with our own capital. Right, that's important. We need to actually be building up our own capital. Savings, it can be voluntary and involuntary. We've got some involuntary savings, and that's that's through pensions and that, to an extent. It's not entirely involuntary, it's semi-involuntary. It depends on each person's individual thing. Yes, and the government can borrow from us, and they have set up retail savings bonds to actually buy. Would you want to lend to them? No, if you're the Greek government, I certainly wouldn't want to lend to the Greek government. But our own government, I'd be prepared to lend to, not a problem. But there again, you've got something that's repeated over and over again. We do not have a savings culture. You've heard that? Sure. What is the pension industry other than a culture of saving? Long-standing, goes over almost 200 years in this country. It's not like in some countries, even in Europe, which is a new, nascent sort of development, you know, pension industry, etc. And what are Stokvels other than a culture of poor people saving? Just curious. But my problem is when people say we do not have a culture of saving, especially from government or the Reserve Bank or whatever, they're busy blaming me for not doing something that they have made unviable. Because the saving, if you save, you lose utility on your money. It's much better to borrow money and spend it immediately than to save. That's how the policy is set up, because you're not even getting inflation for your interest rates for those who save. So you're going backwards, and Provident Gordon still wants to take some of that, which means that you really are going backwards if you save it.
Something that you said was very important to me, and what it was about bread. So where I'm from, if bread and butter is really important, and any big problem has a small, how can we say, heritage where it came from. So if they can't provide, then it leads to much greater problems than just providing for your family or whatever. It leads to poverty or crime. And in my, can you hear me, everyone? Yes, as I was saying, so if you cannot provide, then where do you go from there? Because if you can't find a job, obviously you won't be able to provide, and that leads to crime and further.
Yeah, I'll tell you, for young people, because the old people have already made the mistake. Firstly, we've got to become more internally resilient. In other words, when you've got a job, you should be building up savings. Right, but what happens is people get a job and they don't build up savings, they build up debt. I think if you get a job now and you go to the bank or whatever, for every 1,000 rand of income, you can get 3,000 rand of credit. Wonderful. You can go on a shopping spree of note just on your first paycheck. But the point that I, again, it filters through to the small, medium enterprises thing, is that in your career, if you've built up savings, you can get to the point in your 30s or 40s, etc., where you've gained experience, you can see how a business works, etc. You've got to understand how the business makes money, what are the mistakes, how can you do better, where you then can actually step out of that business and actually set up your own, because you've built up savings and you can make that decision. For those people who've built up debt, right, well, they can't do that because they've got the next payment to make. Okay? So in South Africa, what you've got is the situation where you've got plenty of adults clinging to jobs they cannot stand, all right, because they've got the next payment to make. And then we tell our teenagers to say, well, make your own jobs because there aren't any jobs for you. Whereas the right thing is, if you have people constantly moving out of the workplace because they've built savings and actually then are going into their own businesses, you're making space within the company for them to actually absorb more young people to gain that experience that they need. Not to tell people, you're a teenager, you've got no experience, you've got no capital, so just make your own job. I mean, it just doesn't make sense. So that you make the space in the workplace. It enables people to make progress within the companies more. And that's again what we do. We don't have a dynamic labour market. to actually enable that.
Thanks, Chris. Marlon, and then one more, and then I think we have to close it. This table here.
Thank you. My name is Mbo. I have a question for you, Chris. I don't know if you'll be able to answer it, but I'm just going to take the risk and put it up to you, because you said something quite interesting regarding the bread and butter issues and the struggle issues concerning the upcoming elections for South Africa. And pretty much mentioning where probably the poll would sway, the results would come out. And I'm just asking myself the same question with regard to Botswana. I come from Botswana, and I'm asking myself, because also this is our election year as well, and seeing that we've had a party which has been ruling the same party for over 40 years, what would you say is your analysis? I presume that you probably would have made a bit of an analysis with economies in Southern Africa, and Botswana is one of those. And what would you presume would be the issues that would come up in a country like that? Or what would be that thing that would want to keep the same party or the same rule for over 40 years? I mean, maybe you have an answer to that.
Yeah. I sense that you've got a bit of frustration with that, which is also okay, because sometimes you do need fresh blood, etc. But I like to say the proof of the pudding is in the eating. Okay, would you replace your government that's been there for 40 years with the Zimbabwean government that's also been there for, call it 35 years? Would you like to do that? And the answer is probably no, because the current incumbents, with all their faults, have actually delivered a fairly reasonable outcome for the Botswana economy. And I understand there's all sorts of issues that still need to be resolved, and this is a country that is still going on a journey. But if the data, I need to think, but I think Botswana has overtaken South Africa on a per capita GDP basis, but if it hasn't, it's certainly catching up. Okay, it's certainly of a similar order. And that starts in 1966 with a dirt poor country, etc., with one of the poorest countries in the world in there. So that there's Mauritius has also taken over, but they've had several changes of government. So I don't like governments that sit in power for too long. It's my own point, because it's not that politicians are naturally corrupt. You've got very good people that are politicians, but when you have an entrenched incumbency, right, you tend to have the corrupt starting to make their way up into these structures. So even in the UK, Thatcher wins was in 1979 or somewhere around there. The Conservatives won 3 consecutive terms. What was characteristic of the last term? And they remembered for sleaze in the last term. So who comes in? Labour. For 3 consecutive terms. What are they remembered in that last session? Sleaze. All right. And that's the trouble. We've got at least the advantage in South Africa that the president is in fact changed every 8 years or whatever. In other words, it's 2 terms that they have, and that helps the renewal. All right. But there will be a point where the ANC will be hugely benefited by a single, even if it's just 1 term, just outside government.
Okay, last question, number 5.
For renewal. I suspect the Botswana government is the same. They'll do very well with the term outside government.
Chris, in your own prediction, do you foresee the rand reaching levels below 10, or we should get used to the weaker rand?
Okay, that's a very nice question. Firstly, I believe that in the very short term, while they're starting to taper, and continue to taper, there's going to be a point at which that taper bites and bites hard. And if we couldn't strengthen last year during risk on, we're going to get to a point where the risk off just catapults the rand to a weaker level than what we've seen yet. Okay? And I'm talking maybe 13 or 14 to the dollar. That kind of thing. You know, that, in other words, I don't think we've seen the weak point yet. Okay? But when they start quantitative easing again, you then will start at that point and you will have a multi-year strengthening trend in that rand where it can get to between 9 and 10 again. Okay. Basically where I would be as far as that's concerned.
Chris Hart, thank you so much. I think we're going to leave it there. Chris Hart, Chief Strategist at Investment Solutions.